Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone, and welcome back to our weekly podcast, Through the Noise. My name is Hannah, Portfolio Strategist with the Standard Chartered CIO office, and I will be your host for today. So joining me today is Heung, our Senior Investment Strategist, to help unpack market events and talk about positioning and where other opportunities might lie next. So hi Ray, thank you again for joining us today. So we know that the Middle East conflict has entered into its fifth week. The Strait of Hormuz remains effectively disrupted. But we've started to see some outlines of a potential resolution that are beginning to emerge, although that path is not fully clear yet. So, on balance, it does seem like a ceasefire and a quasi-normalization of the traffic through the strait does remain, weeks away. So I guess the natural question is then, how do you stay invested, diversify, or selectively take opportunity when volatility is really being driven by oil, policy repricing, and risk sentiment?
Hey, thanks, Hannah, for having me. Yes, I think the most prudential method, in our view, is to stay invested in a well-diversified portfolio, while we could also selectively capitalizing on the dislocation created by this market volatility. Now, we think the emergence of the so-called Trump put, which is depicting the propensity to reverse course when domestic pressures reach critical levels, has become apparent in the U.S. And the current trajectory makes a policy shift towards the escalation arguably to us is inevitable. So in terms of the opportunity, we would take advantage of the latest bond yield surge and average into bonds, especially in the U.S. And we view the surge of oil prices has been too excessive. So while markets have largely priced in the near-term inflationary impacts of higher energy costs, it is actually underestimate the medium-term drag on growth. And if you look at the U.S. job market, it's definitely more fragile today, and we think the Fed will cut rates into the second half in 2026 to revive a weak job market. So while the U.S. 10-year bond yield may rise a further 50 to 60 basis points on the back of near-term inflation spike, it could also fall 200 to 300 basis points should job market deteriorate sharply. And so given this, we prefer to average into bonds with maturity, talking about that bucket of 5 to 7 years. We do also see an opportunity to average into gold after the latest liquidity-driven sell-off. Now, gold has rebounded from its 200-day moving average of around $4,100 per ounce, and structural demand from central banks and also investors should sustain, given the rising geopolitical risk. And we retain our 12-month price target of $5,750 per ounce for gold.
Thanks, Ray. And I guess it leads me to my next question on, any thoughts then on how damages to oil and gas infrastructure could really change your long-term view on oil and economic growth, especially on the net importing regions?
Yeah, I think the damage to the oil and gas infrastructure actually raises the marginal cost of supply and also reduce spare capacity, reinforcing a so-called higher for longer oil price environment. And this will have some sort of asymmetric impact to our macro for energy net importers, especially we're talking about Asia and Europe. In our view, they will face significant trade shock risk with higher oil prices feeding into inflation, currency pressure, and growth. On the other hand, if you look at the US, however, they have actually reduced energy intensity and now benefits from its net petroleum exporter status. And this provides a partial offset to macro through the domestic energy sector, although the higher fuel costs still weigh on consumption and financial conditions. I think one trade, though, that we continue to recommend to investors is actually applying some inflation hedges, such as using the U.S. Treasury inflation protected securities, which would offset upside inflation risk which is driven by the sustained oil prices increase.
All right. Maybe let's just shift into maybe equity. So, what are your thoughts on Asia ex Japan equities? Given that the Middle East conflict And we also have the China tech earnings, right? So maybe some of your thoughts around that.
Sure. Asia ex Japan earnings actually remain quite strong in terms of the trend. We are still overweight Asia ex Japan, especially Taiwan equities. Since the Middle East conflict begins, 2026 growth expectations have actually been quite flat, while 2027 growth estimates have continued to rise. So although the AXJ Asia Japan relies heavily on Middle East oil supply, earnings impact has been limited so far, and we think the growth trend would remain positive, which is led by the semiconductor and memory chip industry with strong AI capex. On the China side, we saw major internet and tech companies' earning reports show heavy AI investment, which near term eroding their profit margins, right? But high memory chip prices also are raising some sort of tech hardware costs on that same token. So if we look at 2026 at the beginning of it, the Hang Seng Tech earnings growth for 2026 has actually fallen from 35 to 22%. But, the monetization efforts are likely to be materialized in 2027, where growth has risen from 33% to 37%. So I think with reasonable valuations, we remain positive on the growth outlook for Hang Seng Tech.
Okay, and maybe just somewhere else in Asia. What about, Japan? The January Shinto wage results, they recently were released, and I think we saw stronger than expected wage gains being reported. So how do we see this, affecting the Bank of Japan's rate path, even maybe the yen and the Japanese equities?
Yeah, I think the stronger than expected wage gains from the Shinto report actually reinforced the Bank of Japan's assessment that the wage and price inflation cycle is probably gaining traction. And obviously, the Middle East conflict is also adding inflationary pressure to that. These factors altogether combining will increase the risk that the BOJ will raise interest rate earlier than our original expectation in second half of 2026. But on the other side, and also under our base case scenario of a conflict de-escalation, oil prices will stabilize and making the inflationary impact more contained. Now, despite the robust wage growth that we have been observing, we believe the BOJ would likely to take an approach of wait and see, and hoping that a sustained recovery in domestic consumption to happen before further policy normalization. So if you take the dollar yen as an example, we see upside limited to around 160 due to potential FX intervention risk. We expect the pair to test support at around 156. And for Japanese equity, the wage gains and reflation definitely are supporting earnings growth. And the high energy prices definitely also is a near-term headwind, but it's manageable, especially under a scenario that the conflict will be easing relatively soon. So thereafter, we are looking at the Takaichi government fiscal stimulus, which should be positive for corporate Japan.
Thanks. There was plenty for us to think about and digest, and I think for investors, plenty to consider, even for their portfolios, as we move into the next weeks ahead. So I think that's all we have for today. Thanks again, Ray, for your time, and thank you to all our listeners for joining us on today's Through the Noise podcast. Please do like and subscribe if you've enjoyed today's conversation, and you can look forward to our podcast again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.